a subject that we are all dogged with, or we are all attacked with by most of you. There's an ad running of actually one of the car companies, Maruti, which focuses on mileage. It talks about people being obsessed about mileage. I know that similarly, when you go and meet investors or you go and meet distributors, most of our conversations veer on only one thing, and that comes to the market. In various lingos, it'll be from boss market kaisa lagta hai, to those who are most sophisticated, they'll say but then in terms of the market, how do you look at it? But we seem to have this great fascination about an end result, and I keep wondering about it, that suppose if the market did touch 20,000 on the Sensex, so what, will they close it down, or people won't be allowed to invest, or will it will it be the end of the world? So why this obsession about where it's going to be on whatever 17th October 2015 or 13th December 2014, and how does it matter to people, and why this great obsession? So and as I get older, if not wiser, I find it to be a question that's now actually more and more difficult to answer, because dude, if I knew where the market was going in 2015, I won't be doing this crummy job. I'll become Rakesh Jhunjhunwala, sit in some office and buy stocks myself and not share any of this with any one of you. So I find it a little perplexing why this question is asked so many times from people who have very little clue, except all the dudes who come on the TV channels and who are so particular about 5680 being touched by 12:30 of the next day, and 5440 being the resistance level, and 5520 being the level of support. So I have my take on all this for 10 minutes, and I hope you will bear with me, and hope you'll find it interesting. I think the first issue we find is that while we claim that the BSE is the second oldest, if you look at the exchange in Asia, and maybe the third oldest in the world, we don't have historical data for a long period of time. As a country, we may be obsessed with numbers, but we don't respect them because we don't keep them. So if you look at historical data for the top 30 companies from the Nifty, we have history for 10 years for actually 27 of them. And for 22 companies, we have a history of 14 years. And we have a 20-year history, or close to 20-year history, only for 14 companies. And the point I'm trying to make out here is that it takes 2 business cycles for you to figure out whether the company or its management is really smart or good. And these 2 business cycles occur over a period of 15, 17 years. But we don't have that data for most of the companies. So when we talk of our forecast for these companies, based on any business cycle, we don't have too much data to go back. And I'll give you an example of PSU banks. Except for the case of State Bank of India, which was listed in, for a long period of time and did trade in the mid-90s, no public sector bank has actually a trading history of 2 business cycles. So in the last business cycle of 99 to 2003, when they had very high NPAs, most of these banks were not listed, so you don't have information available on how much stress they faced as such. So you get driblets, but you don't get enough. On the fixed income side, I find it even more weird, is that the 10-year GSEC, for example, which is the actually holy grail of fixed income, the data is only till 2001. Prior to 2001, there is an index which was created by the then JP Morgan ICICI Securities, for which you have an index for the 10-year GSEC starting from 1995. But again, we are putting a large amount of money in fixed income funds, and what's the history we have from 1995 to 2012 is not really a very long history to talk of. So that's the first point that I wanted to say, is that when you make a forecast, we are told statistically you should have a large sample size and you should have a long enough history. And unfortunately for us, that is not an issue that we can work with when we make these forecasts. Second is, as the globalization trend has increased over the last 10 years, Indian companies have become global players. So today, a total 11 companies in the Nifty have got more than 15% of their capital employed in large, they've gone and bought companies from abroad. And that has changed the character of those companies. So actually a Tata Motor or a Bharti Airtel is no longer an Indian company. So they don't reflect India's economy as such as they did 10, 12 years back. So again, as companies become more global and as they have more capital employed in businesses which are in different countries, you will find it be very difficult to make forecasts for them. The third is my favorite, which is the frequent changes in the benchmark. So, and I'm not even getting into the Sensex out here, which has a much longer history. I'll just take the Nifty for the last 12 years, and we've had 50 stock inclusions and 50 stock exclusions in the last 12 years, on an average of 4 per year, and they do change the character of the fund, and they do also reflect the way the markets are. And as a pitch for active fund managers, I think so to us that is the biggest insurance that we will always do better than the benchmark, because if the benchmark is not consistent and keeps changing up and down, and if we are slightly more cautious and smarter and maybe luckier, we will be able to do that. And it's quite interesting. Companies that do get added to the benchmark, the ones which have done very well prior to them getting included in the benchmark, by the third year, 2/3 of them do actually worse than the benchmark. So the trick out here is to buy the stocks as soon as they get into the benchmark and get out of them in the second year, because if you hold them in the third year, 2/3 of them will will give returns lower than the benchmark as such. So again, because the benchmark changes so often, it's very difficult to keep predicting where the market's going to be, because what the benchmark will be in 2015, I don't know, and I don't know which companies will be in it. The next point is on sector weights, and again, this reflects the way our economy is, and we are an economy which is growing, emerging, unlike a developed economy. So sectors which are not part of the benchmark or don't have enough weight get included. If you go back in time, when a large number of you were not present in the market, that was just before the tech bubble. If you look at the boom in terms of those companies' market cap and their inclusion in the benchmark, their weight went up from 5% to 25% and then crashed down to around 12% within a period of 24 months. So 5, 25, and 12.5. In 2007, we've all experienced a boom in terms of power utilities. So if you look at the chart, you will see that in 2007, actually power utility companies had an increase in weight of 950 basis points in 1 year because of Reliance Power being included in the benchmark. Also, you had NTPC and others, and the crash is also as spectacular in the years to follow. Again, a point that while if you invest in a passive fund, you are a follower, and therefore you will have to bear these ups and downs, whereas if you invest with active fund managers, hopefully they will bypass some of these moves and give you returns which are far more stable and actually help beat the benchmarks. The other is if you compare it to actually a developed market and see the weights that we have for various sectors and the changes in them over a 10, 12-year history, and compare that to, say, the case of the index out here, you'll find that the changes which are in a developed market are actually much more moderate, and therefore being in an index fund does make more sense because you are getting into a stable environment where you are able to beat fund managers who are trying to make bets actively. The next point is on again the obsession with the benchmark, which is very narrow, and we did this study. It's not very accurate, but just to give you a sense, is that the top 15 performers of the Nifty, which is actually 35% or 30% of the Nifty, and top 15 of the BSE 200, the returns vary. So you'll find the trick for most fund managers actually is to go outside the benchmark and buy companies outside the benchmark, and that's how they beat most of the time the benchmark as such. And you can see that the green, which is actually the BSE 200 actually performers, top 15 performers, have consistently beaten the Nifty. Again, it's a point that when people talk of ETFs and they talk of going investing in terms of index funds, good active fund managers, by having a judicious mix of stocks from outside the benchmark, are able to beat the benchmark consistently. Again, to go and re-emphasize this point, the number of stocks in the BSE 200, and I'm not gone into the case of mid-caps and the small-cap index, which are even more, where the returns are even more higher. On an average, between 4 to 15 stocks each year have returns higher than the highest of return in the Nifty. So if you, then have a stock in the Nifty which has given a return of 50%, you will find that in the year 2004, there were 4 stocks more than that. In the year 2003, there were actually 8 stocks more from the BSE 200 more, which had given the, there the return was high. The next is a case which I'll call it the Prashant Jain slide. Sorry, Prashant. So it is... and because we are obsessed by him, frankly, in a good way, because he is the benchmark for performance, and we have to make sure that we are close to him in terms of our numbers. Investing in the largest weight or the largest sector, does it give you returns for the risk you are taking? And I think here the history is fairly mixed, except for 2007-8, where you look at the case of Reliance, as the largest stock in the index, was able to beat the benchmark, and you find that funds which were closer to the to that kind of weight did well. Being away from the largest weight in terms of stock doesn't work, but being in the largest sector does work in India. So that's a slide we missed out, but if you were to look at the last 12 years, in 7 out of the last 12 years, being in the largest sector, being the equal weight in the largest sector, today it's banking, gives you return equal to or higher than the return for the benchmark as such. So for 5 years it doesn't, but and the 5 years when it doesn't give, it's the case of oil and gas, when the largest stock was the case of oil, ONGC and Reliance in 2010. The next slide is something which I want to spend some more time on, is that we tend to confuse a bull market with actually market rally. So what is a bull market actually? And what are market rallies? We've had 4 periods in the last 15 years, since I have been in the market for the last 17, 18 years, when we've had people confusing a market rally with a bull market and vice versa. And these 4 are depicted fairly clearly out here. So if you start with the first one, 93-94 was when the market opened up to foreigners, FIIs. GDRs were the big thing. Every entrepreneur, every businessman in India wanted to have a GDR listing of his stocks. That lasted 457 days. Market started oddly at 31 PE and ended at 23 PE. So I know it looks funny, but that's how the truth was. But you'll find that the number of days is just above 2 years in terms of the trading days. Then we had the tech boom of 99 and 2000. This was the most concentrated rally ever in the history of India. There were only 14 stocks which actually beat the benchmark. But they beat the benchmark so handsomely that it looked like a rally. So just imagine in a country where there are 2,000-3,000 stocks, there are something like 50 or 60 stocks that were really up and the rest of the market was down, and we considered it to be a bull market. Again, one sector, IT services, gave returns which made a lot of careers actually. Then we have the 2003-2007, which is perhaps India's only bull market that we've experienced till now, which lasted 1,700 days roughly. And the breadth of the market in terms of sectors participating in this rally was breathtaking, in the sense that every sector, or almost every sector that you could think of which was large in size, participated in this rally. It gave opportunities to people to actually create wealth to a level which was not done before. So in 99, 2000 or 93, 94, there were very few people who could come out of the rally saying that they are 5 times up or 6 times up from the time they started. Because most of them lost everything, when the markets fell. But in this 2003, 2007, rally, though it was, very abrupt when it fell, but the period was long enough for people to realize some of their dreams and make the kind of money, and which is why we call it a bull market. And then we had the 2009-10, which is the QE and valuation-led rally based on March 2009 and how the market did what it did. point we're trying to make out here is that there are differentiators between a market rally and a bull market, and we should not confuse the two terms. So when we talk of a bull market, it's something which comes once in 10, 12, 15 years' time. It lasts for 3, 4 years. It gives you opportunities at various levels to enter. A rally doesn't give you time to, so if you miss it, you would then end up coming at the top. So what are the key drivers of the 2003-2007 bull market? I think we have this concept, Western concept of a perfect storm, which is when all things that could go bad go bad at the same time. I think it was the reverse of a perfect storm in 2003, 2007. Everything that could go right for India went right. We started the 10-year GSEC at a level when our 10-year GSEC was lower than that of Australia. It's hard to believe today, but that was the truth. We were at below 5% or something like that, or 5.9. And though it kept on going up, it didn't cross the level of 7.5%, 8% till the final end. We had a high current account deficit, but it was met by inflows in terms of capital inflows, both on the front of FDI as well as from FIIs, which were of a level that we've not seen as such. We also had periods of fiscal consolidation when the government actually ran for a few quarters a fiscal surplus in a country which has been having deficit financing since independence or since the 1960s. That was a big rarity. And I think so the thing that we miss out the most is it's the only period in Indian corporate history when we had 4 years of earnings growth of more than 20%, And I think so that's the thing that I would like all of you to take back, is in the end, it's earnings growth that matter. And that was the only period that we've had when we had 4 blocks. I think so I have a slide after that. Yeah, I think you can see some of it, yeah. So this is the slide which tells you is that, forget all the experts, forget all the guys whom you see on TV, forget all the fund managers whom you talk to and want to talk to, is that if you have periods of 4 years of earnings growth like we've had between 2004 and 2007, unless there's a nuclear war going on in the rest of the world, we will have a bull market. And if we don't have that, then however much we talk or however much the government comes out and announces measures or reforms, it'll be a market rally and not a bull market. And the last factor over the last 4 years, have been fairly traumatic for equity investors, both for you as well as for us. And believe me, it's as frustrating to manage money professionally when you don't know whether it's risk on or risk off or risk on again or risk off. And it's because there is increasing correlation between what happens in the developed markets and what happens in emerging markets. So the chart is fairly well depicted. The one on the right-hand side, which is the S&P index, is something which we saw is that, and the global markets are increasingly led by the announcements of the central banks. So the chart here shows that if you take out the 6 days in which you had announcement from the US Fed, FOMC meetings, the returns are 600 bips lower than what the US would have actually registered. So if US sneezes, India will catch a cold. So that's the harsh reality today of the last 4 years, is as we get increasingly globalized, it does matter to us what happens in other parts of the world, and we have to be aware of those issues. So finally, to end on a slightly more positive note, is that we've come out with an equation. So we've come out with a holy grail on how to create a bull market. So it's a function of E, G, V, EI, GF, and PS. So anyone wants to guess any of these factors? So EG is strong earnings growth. As I said, it has to be about 20% for 3 years. Valuations have to be below the 10-year average at the starting point. Macroeconomic indicators, EI, should be improving on a 5-year basis. Global factors should be tranquil, and we should not read about them in our newspapers and at least on the front page. And CNBC should not spend time and program on what's happening in the US and Europe. And lastly, political stability is something which we tend not to look at most point of times. We take it as given. But when you read about it or when people start discussing it, then it becomes an issue, and that impacts the market. So if you can get a concoction or a period of time when all these factors are present and you can see them clearly, then you don't need an expert to tell you that you're in a bull market. Until then, you don't need to believe that you're in a bull market otherwise. Thanks a lot. Thanks.
So, Prashant, are you going up next?